If you think big tech will keep outperforming, then you're mistaken. At least that's according to today's guest. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce, and with my co-host Ren, today we're unpacking lessons from 50 years of stock market history and learning why the past 10 years may not be instructive for the next 10. Ren, good to be with you.
Bryce, good to be with you. Excited for this one. Today we're speaking with Simon Skinner. He's the head of the global investment team at Orbis Investments. He's out here all the way from London, made the trip especially to join us in person in the studio. So we appreciate that.
We very much do.
And we're going to be talking about stock market history. And as you said in your intro, how perhaps we're being deceived, we're being fooled by the last decade, call it, of stock market history, and maybe why that is an anomaly based on the longer term trends.
Yes. Not only that, we're going to be covering off how we can manage the current market. Simon thinks that it's speculative, unbalanced, and risky. We're going to cover off how they're thinking about emerging markets and investing there. And then two stocks that we found very interesting and we hadn't heard of, Smurfit, Westrock, and Jardine, Matheson, going deep.
Yes. Specifically for both of them, we weren't going to talk about AI, but AI comes up in every conversation. Two companies, two industries that Simon is confident won't be disrupted by AI.
Yes.
So you can have a listen to that. And then as a bit of a tease, one quote I wrote down that Simon shared, he said, "In hindsight, it will be clear that this was an opportunity." We won't say what he was talking about there. You'll have to listen to the interview. But before we do, we want to say a massive thank you to our partners here on Basis Points, Orbis Investments, SIBO, and Milford.
And a special thanks today goes to Orbis Investments. For over 30 years, Orbis have been focused on finding global stocks that are undervalued or overlooked by the market. This approach is all about the long term, looking beyond short-term performance to identify companies with real potential.
With a team of over 60 investment professionals worldwide, Orbis sticks to a contrarian investment strategy. Managing over 60 billion Aussie dollars in assets, their focus on value can create a great way to add diversification to client portfolios, especially in today's ever-changing markets.
Now, before we jump in, a reminder that all of the content here at Basis Points is accredited by the FAAA, and today's episode will be available for CPD points. All you need to do is click the link in the show notes or description below, complete the quiz, and we will send you your certificate.
All right, well, with that said, let's get to our conversation with Simon Skinner from Orbis Investments.
Simon, welcome to Basis Points.
Thanks, great to be here.
So you said investors have short memories. What lessons from the past decade do you think that we've wrongly internalized?
So I'll give you a bit more context than that. I think a great way to invest is to be a student of history, but you have to look over really long periods of time to figure out what works. And so if you look over kind of 40, 50, 60 years, you can understand the types of things that generally lead to good investment outcomes. If you look over some shorter time periods, you can end up in very dangerous places where you're learning what's just worked for a short time period, but because everybody else has learned that at the same time, you end up in a herd and that thing ends up rolling over. So if you go back through history, you get periods for 3, 4, 5 years where something works and everyone herds into it. So you could have like the Japan bubble in the 80s, or you could have the dot-com bubble at the end of the 90s. And that leads to some trauma for the people who've kind of herded in at the end of that craze. And those things unwind and you learn the lesson there. The thing I think is particularly concerning today, or a bit dangerous today, is it's been the same kind of environment for a long time, and I don't think it's sustainable. And so previously those episodes have been 3, 4, 5 years. The last one's been like 10, 12 years, where if you've been invested in growth in the US in large stocks, you've done really well. And if you haven't done those things, you've probably been fired from your job, or you've been fired by your clients, and you have endured years and years of psychological pain. Even though the thing that you're doing, you know deep down doesn't make sense. You've kind of been trained to do something which actually if you look at long periods of history, doesn't work. So if you look at the performance of just buying growth stocks over time, generally that's a bad idea. If you go back kind of 60 years, you've underperformed doing that. If you just buy the biggest stocks in the index over time, you've underperformed doing that over very long time periods. But over the last decade, that's what's worked. And so the reason I think it's dangerous is this is what the whole cohort of investors who run money today, or passives, because they kind of do the same thing, have all been trained in these dynamics. and all put their capital and positioned themselves for that to continue for another decade. And so if long-term history teaches you the right lesson, that's going to reverse at some point. And I think everybody's positioned for one side of this bet. And if it changes, and I think when it changes is the right answer, it could be quite traumatic for those people, and it could be quite chaotic as those bets start to unwind and people realize they have to allocate their capital in a different way.
So let's separate the short-term trends from the long-term lessons.
Mm-hmm.
What does the last 50 years, 100 years, what are those enduring true lessons that you think we should focus on?
One is that generally buying stocks with low expectations beats buying stocks with high expectations. So value versus growth. Now, that doesn't mean you should do it all the time. Orbis believes that you should be an intrinsic value investor, and so you should try and buy things that are priced below their true value, not necessarily just things that have cheap multiples. But generally, buying things where expectations are low, sentiment is low is a better idea. And that's the opposite of what's worked for the last 10 years. Generally, buying stocks on a very diverse basis, rather than concentrating in the largest stocks, is a much better strategy. So owning the largest stocks, it can have periods where it works, but they tend to be kind of booms. So you saw it in the dot-com boom, you've seen it over the last 10 years. But over long periods of time, an equally weighted portfolio will outperform just owning the biggest stocks. And then the other one is regional diversification. So the US and developed markets have done very well relative to emerging markets for the last since the GFC, effectively. But if you go back 50 years, actually, it's just a long cycle. And sometimes emerging markets do well, and sometimes they do poorly. But actually, if you were looking to have a kind of diversified approach through the cycle, you wouldn't want to be too skewed in either direction. And I think you can be mindful that you have these big shifts in narrative and sentiment, particularly on a regional basis. So if you think about where emerging markets are today relative to the US, we look at a spread of valuations. So what's the difference between the valuations of the indices? The indices, sorry. The gap today between emerging markets and the US, the only time we've seen it be this wide is during the Asian financial crisis. So when you had like currencies massively devaluing, you had like full-on chaos in the financial systems, you had sovereign defaults. That was the environment that caused investors to be this negative about emerging markets relative to the US. Wow. And if you go forward to today, there is no chaos, right? These countries are generally doing okay. They're not as exciting perhaps from an AI perspective or something, but the narrative has shifted to be very negative in those areas and very positive in the US, particularly in those big US growth stocks. And in hindsight, it will be very clear that this was an opportunity. At the moment, it doesn't feel like there's anything that's going to shift that narrative. But we'll look back in 5 years' time and we'll say, well, of course the valuations were so stretched and it was an obvious thing to do to move your capital. And I think the thing that's going to be interesting to watch is you've got these massive liquid marketable stocks in the US that everyone is positioned in. I'm pretty sure every global portfolio owns some of the Mag 7, for example. Yeah. The things which look relatively very good value are very diversified, much smaller, have much lower liquidity. And if you try and empty a fire hydrant into a drinking straw, you can imagine that the price moves you're going to crystallize are going to be quite dramatic. And sometimes in markets, the narrative follows the price move. And so if people just start to question, well, do I want this much overweight to those types of stocks? I'm going to move some over here. The prices will start to move and suddenly sentiment will start to shift. It will create panic. And, this thing could unwind quite quickly.
It seems though that people can try and keep writing off the Mag 7, but they keep surprising. They keep just churning out time after time after time.
And like the businesses keep doing it, not just the stocks.
Yeah. How do you separate like the lessons of the last 50 years with the fact that this could go on for another decade with those particular companies?
So it could do. Like I can't say this time is not different. That's a very dangerous thing for an investor to believe. I think a couple of things that I find interesting. One is the nature of those businesses is changing. So previously they've been capital light businesses that have been able to scale and grow very quickly and actually generate a lot of cash at the same time. If you look at what's happened over the last 18 months, they are still growing and they still look well positioned, but they've become very capital intensive. And that is quite an interesting shift. And you think about like, what would you pay for that growth? How much is it worth? The other is that it's very difficult to pick winners when you have a big tech shift. It was actually very difficult to go back to the dot-com boom and say who's going to win out of the internet change. And so where you have these big disruptive technology changes coming through, to think that all those 7 companies are going to be the big winners I think is a difficult thing for me to accept. I think it's likely that the tech change opens the door to competition. And you've already seen this with something like Alphabet, where search is unquestionably being disrupted by AI. That probably happens in different parts of those other businesses as well. And so maybe some of those stocks do go on to be big winners, but probably all of them don't. And they're all massive. And if you have a business which is less competitively advantaged than it used to be, so the moat is still there, but it's smaller and it's more capital intensive to run that business, you probably wouldn't put the same valuation against that you do today or you had done in the past. And so I think, and as you see, you can see like an OpenAI or someone like this come and challenge them, they will attract a lot of capital. So the cost of capital to compete with these businesses is also very low today, which tends to be bad for future returns.
So we want to ask some questions around how investors should manage the current market based on some of the insights that you've shared there. But before we do, you've walked into the studio today, and I've clocked that you don't look that old. I reckon ballpark you're about the same age as us. So you haven't lived through a lot of these massive market changes that you're talking about. So I want to understand how you learn about them, how you research them, and how you kind of draw out the lessons from them, because I'm sure whatever you're doing, we can try and emulate as well. So what has been your process to kind of ignore the noise of the moment and learn about more longer term trends?
Okay. So my background is actually I qualified as a lawyer.
Oh, okay.
And I joined Orbis at an amazing moment to be as a kind of student investor in 2008. So the week after I joined Orbis, Lehman went bust.
So you have lived through some big market ruptures.
And actually it's a wonderful time to learn because I had none of the psychological pain of everything falling apart, but I got to kind of go into the store in discount mode in 2008, 9 and 10 and see that you had these big dislocations and see what real panic looked like. And then I got to see how people who'd been at Orbis for a long time operated in that environment. And so, stocks were moving wildly in the press and in the headlines. And then I'd look internally at what's happening at Orbis, and people were saying, is this business good value on a 5 to 10 year basis? Where are the best values that I can get today? And can I find a business that's resilient to what's going on today, which is terrific value? When everyone else is kind of losing their heads, they had a very cool approach. And then I said, and then we looked at the returns that delivered. And I was like, this is quite promising. And we had a great track record as well. I guess it comes from a place of humility, not thinking that I could reinvent the wheel. The best thing I could do at that point was learn from Orbis. And so, we had Orbis that had been around at that point for 20 something years. We had our sister company, Alan Gray in South Africa, who'd been doing the same thing since 1973. And so I kind of tried to learn from all the case studies that we had through that period of history. And that made me curious to go further back. One thing we are bizarrely good at is writing everything down and recording it. So every piece of research that's ever been produced in Orbis is in our document management system. And so if I want to go and read about what were people saying about Cisco in 1998, there's a document for me to go and do that.
Wow.
Or I can go further back and read about what were people saying about Japan stocks in 1990. And so that archive was actually very useful in kind of gaining historical perspective into what we're living through.
So I imagine the Alan Gray archives, if they go back to the 70s, there's probably a lot of parallels to today because, back then it was no one gets fired buying IBM and there was those nifty 50 stocks that everyone was buying and the market was quite clustered and consolidated, similar to the mega cap stocks today. Does the archive go back that far?
I haven't looked back to the 70s.
Okay.
I've focused that was a South African focused business.
Oh, they weren't globally.
Orbis is the global investor for Alan Gray. So I've kind of stayed in that realm. But you can definitely go and see the pressure that people are under when they were owning, brewing companies and supermarkets in 1999 when everyone else owned Pets.com and Cisco. And you can see the conversations. We've minuted all the meetings, so you can see the conversations that were people having and just scratching their heads and saying, this can't last. But the pressure was there because we were underperforming. Yeah. And they held firm and they owned very boring businesses. I'll come back to boring businesses later, but they owned very boring businesses that were kind of, not even people were kind of necessarily negative about. They were just complete apathy. They were just not exciting. They're nothing, interesting to write about them. When, all those other stocks, the sentiment came down, it was these things. And, the performance we delivered owning really boring businesses for several years was incredible.
Have you guys put all those documents through AI?
We are in the process of doing that.
I'm just imagining the wealth of information you're drawing.
We do have an external service where we've loaded all our data into, And so now we can go and start to draw out the patterns and the lessons
Wow.
using natural language, which is pretty powerful.
Yeah.
And it's amazing that we're in the process of, you can bring people to life. So we are on a journey to be able to ask, say, what would this person have said about X?
Oh, wow.
So Alan Gray, our founder, has passed away several years ago. There are now tools that will be available so you can bring someone to life and ask for their opinion about a stock based on what they've said previously. We can't do that yet, but it's pretty exciting to be able to do that in the future.
Jeez. It's crazy.
Well, I'm looking forward to the Warren Buffett version of that.
So I've seen somebody has done this for Warren.
Okay.
So they've loaded every transcript, every interview that he's given, and now they have an Ask Warren GPT.
Wow. All right, well, that's the rest of my day done.
So we want to move to managing the current market. You've described today's market as speculative, unbalanced, and risky.
Yeah.
So what do you mean by that?
It's the concentration of capital across what should be a diversified opportunity set. If you were to imagine every stock in the world index on a large sheet of paper, and you were to put dots for each stock, and the closeness of the dots on the paper would be how closely those businesses or the stocks behave together in different environments, so how correlated they are effectively. What you'd see is this kind of massive cloud of dots, quite spread out, and then if you were to colour them by region, you'd find that broadly they kind of split into quadrants. So you'd have North America, you'd have emerging markets, you'd have Europe, and you'd have Japan and other. And they'd kind of create this kind of quadrant of different colours. If you then overlay the current market cap weightings onto those, what you find is that the US has a huge portion of the weight. And so the centre of gravity is basically in the middle of the US. And it's skewed to very large stocks that have great momentum over a long period of time. They've been high growth, and they have some kind of technology focus. And so you've got this huge opportunity set, but the weight of capital in the market is skewed to this very concentrated basket of stocks. And for all the reasons we discussed at the beginning about how we've got here, which is investors have been trained that these are the only things that will work, I think that creates quite a lot of risk. And so you think about the opportunity set, like you could actually be very diversified. Like there's an opportunity to own things in all sorts of parts of the world that are very different to what everybody else owns. And I think that seems like a prudent thing to do, particularly at the moment. If you look at just valuations, like the US index is trading at a much higher multiple than it has historically. And there's a pretty clear correlation between what you pay today in terms of earnings and what you get over a 10-year view. And if you run that correlation today, you might expect a kind of low single-digit return from the S&P 500. I think that'd be quite disappointing for a lot of people if that's realised.
Yeah. Was certainly not what they're expecting when they're going so heavily into it. I guess we've covered the risk around concentration in US mega cap stocks. Are there any other risks that are bubbling under the surface that perhaps we're not as cognizant of, or perhaps are not getting as much attention?
Quite a lot of things feel stretched. So you can look in currency markets and see that some of those valuations look quite stretched. Also, the US dollar generally looks quite expensive versus many other currencies. It's all a relative game. You can see things in the world that are happening which could be inflationary, and then you're seeing long bond yields start to rise in many places. I think it's interesting that 5 years ago, maybe 5-6 years ago, stocks were kind of objectively reasonably expensive, but you looked at the long bond yield, which was very low, and you said, well, okay, if you use that some kind of discount rate calibration, maybe this is a reasonable price to pay for these businesses because the growth is worth more when the discount rate's low. If we roll forward, the valuations today are similar or higher, but the bond yields are much higher too. So I can't see how you can have your cake and eat it in terms of, now you don't have that discount rate argument, and yet the stocks are just as expensive or more so than they were. So I don't know what changes in this dynamic, but it feels like people are kind of having to stretch a bit further and further to justify the valuation, especially for these larger stocks.
So in markets like we're seeing at the moment, exhibiting signs of sort of irrational behaviour, what role can decision analytics play in helping us make investment decisions?
Okay, so Decision Analytics is our in-house coaching service. So we have a team who I explained that we kind of write down everything. We also record every part of our process. So not just when we buy and sell a stock and the trading, but actually we looked at the whole investment process. So where did the idea come from? How quickly did it get worked on? Who did the work? What did different people say at different parts of the process? And after we own the stock, so once we've decided to buy a position, what happened to our estimates of intrinsic value? Were they rising or falling over time? How often do we meet management? What were our views when we did meet management? What other research did we do? And we can look through this. We can use AI to help us, to discern patterns in our behaviour and try to eradicate biases, but also to help boost our decision-making quality.
Wow.
Which is, frankly, it's a journey, and there's two halves to it. One is doing the analysis, which is complex. The most important part, though, is changing behaviour. And it's kind of ends up being like stock therapy when you see the team, because they know what your bad behaviours are, they know what your good behaviours are, and we see them on a regular basis and talk. And so they say, "How's it going?" And you say, "This is my portfolio," and they say, "Well, that looks like what you were doing in the past that didn't work very well." And you have to kind of have a confessional where you're like, "Well, yes, I still am doing that thing where I keep buying losers or whatever it is." But they're trying to encourage you to change your behaviour to something which is more constructive for you. So the most important thing is that the advice they give and the perspectives they bring are personalised. So it's not kind of based on what things generally happen. It's the behaviour that I've exhibited over 17 years at Orbis, and they're helping to coach me to be a better investor.
Wow.
God, I would love someone to do that for my portfolio.
It's very humbling.
Very
humbling when you think that you're like, I've been doing this for a while now. I should have exhibited some skill, and they can identify 3 or 4 things which, when they write them down, sound very basic, and yet you find yourself drawn to them because that's the biases that are built into our basic human systems. And so just having that conversation on a regular basis is helpful in terms of course correcting. And then we set up a system of automatic nudges. So when a stock starts to exhibit certain characteristics, or my behavior around a stock exhibits certain characteristics, I can have a message, an email, a conversation that is predetermined to say, Simon, watch out. Or like even things as basic as sleep on this. Don't do this now.
Okay.
Like, go for a walk in the park, sleep on it, come back tomorrow morning. If you still want to do it, then fine. But historically, you've done much better in this situation when you've just taken a break and stepped back from the coalface.
That's epic.
I'm just now imagining, we've spoken about AI a bit, but I'm imagining in 5 years, as AI develops, what that's going to do to this system that you guys have at Orbis.
It could be very powerful.
Yeah.
I've challenged the team. My mandate to them is to improve our returns by 50 basis points across all the strategies.
Okay.
And I think that's realistic. Because if you think about, we're driven ultimately by a team of individuals making decisions. And I think that people are inherently biased. Even good investors are biased. They're fighting that all the time. They're just a bit less biased than other people. And so if you can bring consciousness to that decision process and you can make people a little bit better, that's going to have a real impact for our clients. And 50 basis points really matters, right? Over decades, that's really going to add up. And so I'm really enthusiastic about the efforts that team are making.
Awesome.
Well, we'll be watching. Now, we have asked you to bring a couple of stocks to talk about today. We're going to cover one now, and then we're going to cover emerging markets in a little bit, and we'll talk about an emerging market stock towards the end. The first company is Smurfit Westrock. Now, I hadn't heard of the company before, but so I'd love you to tell us a little bit about what it does. But in the context of Australia is the home of some giant packaging companies, Visy and Amcor. So, Aussie investors, Aussie advisors probably are familiar with a little bit about the packaging industry. So tell us about Smurfit Westrock and how it compares to some of those familiar names.
Okay. So I've been talking about Smurfit in Australia for a couple of weeks. The pleasing thing for me is that no one's heard of it.
Yeah. Okay, well, good. I'm not alone.
I talked at the beginning about the value of boring companies.
Yeah.
Like finding things that people are not excited about at all, not in the press. That's great to me. This company makes corrugated cardboard boxes. Like it has a very, very boring business. Very hard to get excited about this. But I'll give you the backstory because it's important to understanding why we're excited today. Smurfit Westrock is the result of a merger which was kind of put together over the last couple of years. It was originally Smurfit Kappa in Europe and Westrock in the US. Smurfit Kappa in Europe was run by a guy called Tony Smurfit, so he had his name above the door. Within the European context, I'd followed that business for about 15 years and seen Tony and his team do a tremendous job in a boring, low-growth industry. And the way they had done that was being very good industrial operators and understanding that the box business is cyclical. So sometimes demand outstrips supply, sometimes supply outstrips demand, and so returns follow that pattern. In the good times, Tony didn't get too excited. He invested in his operations and made them more efficient. So he put in the best capital equipment he could find, really worked on optimizing the kind of production footprint for any given region to make sure that the right plants were making the right boxes. And so he had better margins than all his peers and better returns on capital. In the bad times, he would go to his competitors who were distressed, who had typically overexpanded, and buy those assets well below replacement cost. Okay, so he wasn't increasing overall industry capacity, but he was getting good assets at really good prices, understanding that the cycle would turn at some point and the returns would come back. And then he was able to go and improve those assets as well. And that playbook had been rolled out for 15 or so years within Europe quite consistently, and kind of, he'd really built a good reputation as a good industrial operator. 2 years ago, I think Tony looked across the Atlantic and saw that Westrock was a good opportunity. And so it was there for a couple of reasons. One is there had been a big cycle in the US corrugated box market. So during COVID, everyone sits at home and orders everything they can on Amazon. And so box demand goes up. A lot of the packaging is required for this kind of remote delivery. So box capacity was added. The industry returns were really healthy. 2 years later, when everyone goes back to the mall, box demand dropped off. You also had a bit of a kind of like an industrial recession in the US. So, lots of physical goods, the demand came down a bit. So returns came right down. And so, just generally the industry was in a bit of a low point. And Westrock had been a problematic business, not because the assets weren't good, but because it had been poorly managed. And it had been poorly managed for, I think 2 or 3 iterations of management. And so shareholders were quite pessimistic about the outlook for Westrock at this. You had a business that was cyclically depressed and had been a poor reputation with the management team, which was frankly well earned. Tony looked across the Atlantic and said, well, I've got this playbook on how to improve industrial packaging assets. And I think the assets are good. He actually had some history with owning the assets a long time ago as part of kind of different M&A. And he said the cycle's low. This is a great time to strike. And so he proposed a merger that ended up going through, I think, a couple of years, like 18 months ago. And so today what we have is two big sets of assets, one in Europe, one in North America, both of which are somewhat cyclically depressed. The assets in North America are actually bigger now than the ones in Europe, but there's a real scope to improve those. And so I think, we trust that the Smurfit team can take the playbook they've executed in Europe really well, bring it to the US, and will drive much better returns from those assets in the future. So that's promising to us, and it's a reason why investors are mispricing the situation, is they're not really willing to look through the near-term cyclical downturn and appreciate how good the Smurfit team have been in Europe to think what the Westrock business could look like in the future. There's a kind of additional leg to this, which is the US market has meaningfully consolidated over time. So it used to be quite fragmented in terms of box suppliers. There's now 3 big guys who basically control the market. And so on top of that, I think industry returns will be better, because typically when big industrial businesses or industries consolidate, returns generally come up because you have more discipline. So if you are executing a good turnaround as the cycle recovers in an industry which is fundamentally improved, earnings could be much better than people are anticipating today. So we have all of that, and then we look at the valuation and we find that Smurfit Westrock trades at like a 30-40% discount to its peers.
Oh, wow.
So you say, if earnings are really, earnings growth impresses to the upside and that discount closes, so that seems like quite a constructive setup. I don't have to bet on the timing of the turnaround either, because it has a good balance sheet. So I'm not panicked here saying, well, I really need this to move by the end of this year or next year because they've got debt that needs to be refinanced, and I don't know what happens if they can't access that. They're going to raise equity. That's all off the table because the balance sheet is solid. So good management team, good balance sheet, a non-time sensitive turnaround, but there's some uncertainty near term. That works quite well for my investing framework.
Yeah.
And then the icing on the cake is there is no way that you can incorporate AI into a cardboard box.
Wow, famous
Really?
last words. Yeah. Maybe in the production process, maybe.
So we can maybe that it becomes slightly better business because they can use AI better than peers, but I'm not going to bank on that. But if I think about, where is sentiment around cardboard boxes versus anything touches AI or tech, it's got to be polar opposite. So I don't have to bet on tariffs because boxes are consumed locally. They don't really cross borders. I don't have to worry about sentiment unwinding in hot areas of the market. This is something that's off the radar, but I think is just intrinsically very good value today.
Yeah.
Just on that AI point, we want to talk about the risks here, but just on that AI point while it's here, are you just staying clear of anything at the moment that it's unclear of the impact that AI could have? Or like, how are you actually approaching?
It will be quite hard to discern how AI impacts companies which are obviously in the middle of that ecosystem, because it's clearly going to be disruptive and change a lot of things. Picking the big winners, I think, will be hard. And I think given where interest and sentiment is, you're going to have to pick the big winner to do well from here, because people are already so excited about everything that touches that space. The way I think about it, though, is this is likely to be a point of change. And I think businesses that have a proven ability to deal well with change may be able to gap their competitors. So there'll be a step change in how quickly they can adopt AI, what it'll mean for their competitive advantage. And so I would think about executing this as looking for businesses that have a proven better culture, a proven ability to adapt and grow and experiment. I think you'll often get this in businesses that are still run by their founder. And businesses where you can see that they have out-competed their peers over like a generation. They probably have a better ability to innovate in particular. And so I mean, there are some businesses which I think are toast. So like, call centers.
Oh yeah. Okay. Yeah.
If that's your business model and value add, then I think that's going to be really challenged. And so there isn't really a price that I'd be interested in things which are clearly on the structural wrong side of this. But I think for most businesses, AI will become a tool in the same way that a spreadsheet was a tool, or like CRM was a tool.
Yeah.
And so then you think, well, who's going to adapt quickest and best to that? And maybe you put more of a premium on that in your analysis.
Simon, we're going to take a quick break here. On the other side, we're going to dive deeper into the case for emerging markets. But we want to pause to say a quick thank you to Orbis Investments.
Orbis has been investing in undervalued and ignored global stocks for over 30 years. They're interested in long-term potential rather than short-term performance, and their international team of 60-plus investment professionals concentrate on unearthing companies trading for less than they are worth, rather than timing market trends.
Orbis has applied the same fundamental, long-term and contrarian investment approach since its inception and has over 60 billion Aussie dollars in assets under management. With the investment landscape rapidly changing and with valuations where they are today, Orbis's contrarian style and high value exposure can make it an effective diversifier in client portfolios.
Partners like Orbis help us to keep the content at Basis Points free and accessible to everyone, so a huge thank you goes to them.
Welcome back to Basis Points. So we want to drill down on emerging markets because earlier in this conversation, when we were talking about, some of the investors have short memories and some of the lessons from the past 10 years won't hold us in good stead going forward. And one of them has been emerging markets has been, I guess, unloved, out of favor, underperformed US large caps like everything else. So I guess make the case for us. Why should we rethink about emerging markets?
So let me put some context around it.
Yeah.
So emerging markets have lots of things. Right? They have lots of people, so more than half the population of the world. They have quite a big chunk of GDP. Look at it, surprisingly big. So I think it's around a third. And actually, if you just look at the market capitalization of the stocks in emerging markets, it's about 30% of all of the companies in the world. But the way the indices are constructed, emerging markets today are only 10% of the world index, like the most people would use, like an ACWI. If you look at the global funds that are used by advisors and retail investors in Australia, that weights 6%. Okay, so less than half of what the index has, and the index is underweight what you just get if you just add up the capitalizations. Why is that? Well, part of it is the growth hasn't been there as strongly in recent periods. Like they have more exposure to kind of, I guess, like old industry, like heavy industry, extractive resource businesses, that kind of thing. But the other is just the valuations are really low. So if you just look at the valuation of the emerging markets versus the world index, it's about half. So something like 13, 14 times earnings in times PE in emerging markets, it might be almost double that for the world index today. And as I kind of talked about at the beginning, that's a very wide spread. And actually, if you look at the quality of the businesses, they're not that different. Typically, when you find situations where the valuations are very different and the quality of what you're buying is not, you're better off owning the things where the valuations and expectations are lower. And the only time we've seen this spread this wide in kind of, even my long lens of history is back to the Asian financial crisis, when it was, genuine chaos and you had kind of big disruptive forces. We don't have that today. Like, things are okay. Like, the governments are in okay shape, the consumers are in okay shape, demographics are no worse than in developed markets, often better. The middle class is still emerging in many of these economies. They're not over leveraged. So to me, it looks like quite an interesting setup of just sentiment is what's depressed. And if you look at where emerging market returns have been since the GFC, effectively, emerging markets have done about 3% per annum. Developed markets have done about 10. And so if you've been kind of enthusiastic in this direction at any point in history, you've kind of got run over by that trend. And so people have just been trained that there's no good returns here, and they create a narrative around why there's no good returns. Well, it's governance. Well, it's sovereign risk. Well, it's X, Y. You come up with, and like the market trains you to create a narrative to justify this pattern. But actually, when you go through and look at the fundamentals, we think there are pockets where they're really good. And so we've got a team in Hong Kong, been doing this for a long time, run by Stefan, and because they go bottom up and because they go in a very granular way, we're pretty confident that they're able to dodge some of the bullets that you can get in emerging markets. So governance is more of an issue. They have sometimes take a different approach to what minority shareholders, how they should be treated. But if you're owning a handful of good companies that are kind of caught up in this negative sentiment, you can construct a very attractive portfolio that looks very different to a global index and has financial characteristics that you would pay a lot more for if they just happened to be listed somewhere else.
One point of clarification that I want to get when we're talking about emerging markets is just where you guys draw the boundaries of emerging markets, because the classifications always blow my mind. Like South Korea being an emerging market, Taiwan being an emerging market, China being an emerging market. Like when we're talking emerging market, but then on the other hand, we're talking about like South Africa, Brazil, the Philippines, Indonesia, like countries and economies that are very different at this point.
Yeah.
When we're talking emerging markets in this conversation, what part of that emerging market universe are you particularly focused on?
Probably quite a conventional boundary, I guess. So I think we would include, Southeast or Asia ex Japan, LATAM, and a select few other countries.
Yeah.
And we try to be flexible to go where the opportunities are rather than where some guy in an S&P office somewhere decides the boundaries should be drawn. So we found some good, we found an interesting opportunity for a company that's based in Estonia, for example, which is kind of, you wouldn't classically say fits in emerging markets, but it's not a developed market either. So, but we actually found it was the company that was attractive rather than the country.
Yeah.
Well, speaking of companies, let's use one that it sort of illustrates this, and it's Jardine Matheson. What does the company do?
So Jardine Matheson is effectively a holding company based out of Hong Kong. The company logo is a thistle, which is important to kind of correlate to the management team. So it's run by the Keswick family, and we're on the 5th generation of CEO from them. And I talked about being a student of history. It's really helpful to us to be able to understand how cultures have evolved at companies over very long periods of time and how the returns have been delivered. So we can go back and see for the whole time that the Keswick family have been running Jardines, how have they done and how have they treated minority shareholders? And it's generally been very good. Compounded capital for a very long period of time in a very responsible way. So they communicate clearly, they treat people very fairly, you know what to expect, and they also show themselves to be great stewards because as a holding company, they own stakes in a series of other businesses, and you can see that each of the businesses they've invested in have generally been good businesses too. And their job as capital allocators is to allocate capital to the next good idea and help those businesses grow. And that's what they've been able to do across many businesses, different regions. But the broad trend has been they've added value from an economic perspective. And so that we find that a very interesting governance structure to be involved with. So if I walk through kind of their big assets, it's helpful. So they own Astra is a big driver of their returns. It's a big Indonesian conglomerate. It tends to have an involvement in many things in the Indonesian economy, but it's got a big exposure to motor dealerships and also the financing arrangements of those, which has tended to be a good business over a long period of time. They've got Hong Kong Land, which is the kind of premier real estate developer in Hong Kong. So they own tier 1 offices, tier 1 retail and tier 1 residential. So very high quality residential real estate business. They have DFI Retail, which is the franchise owner of IKEA in Hong Kong and Taiwan, and also 7-Eleven in Hong Kong. They are terrific retail assets. And then they've got a tail of smaller things. Probably the one that stands out is Mandarin Oriental. So the premium hotel brand across Asia. Now, all of these are quite interesting standalone businesses, and they're often listed in their local markets. So they have a kind of a listing, and then Jardine's owns a big stake. So you can see what they're worth. You can see what investors in Indonesia are willing to pay for Astra and what investors in Hong Kong are willing to pay for Hong Kong Land. You add up their stakes and you get to a value of about $18 billion. You say, okay, well, I don't own any of those companies, frankly, because I've got a good management team overseeing the portfolio. When you buy Jardines, you pay 12.
Oh, wow. Big
So,
discount.
Big discount.
Yeah.
Now, holding companies can attract a discount, but typically the discount's there because people don't trust the management team because they've done something. They're either serving themselves above minority shareholders or they've destroyed value through capital allocation over time. Here, we have a management team who've proven to add value over time. And so the rational thing to do might be to pay too much. That's not going to happen. But we don't think that level of discount is justified at all. Now, I can't explain why the discount is there. I think it just reflects the negative sentiment that you've got, from global investors towards emerging markets. But one of the things I've learned over time is that sometimes you do see $5 on the floor, right? And sometimes it is $5. And not to question it too hard when you do, but to just make sure that you own that for your clients, and then you wait. And sometimes you wait a long time. But generally, if you buy things which are at very good value today and are increasing in value over time, that's going to lead to a good outcome.
Yeah, wow. Nice.
So when you look at that discount relative to the listed sum of its parts, how does that discount compare, the discount today compare to like it historically? Like, has it always traded at that sort of like...
No, it's been extending over time.
Yeah,
and you can kind of correlate the discount to where you see emerging markets being discounted for developed markets. So you can understand that sentiment is playing into it.
Okay. So that then you would expect that over time it mean reverts back to...
That would be part of the way we could earn a return, but also just the businesses doing well will drive the return as well. And so I talked about earlier with Smurfit about having a number of levers to getting return out of the stock. I think you've got the same with Jardines, where you've got, the underlying business is doing well, and then you've got the discount closing. So you can kind of add the levers up, and that gets you a nice return.
So the thesis then is the management team, the quality of the business is underlying it, the discount there mean reverting. Is there any other elements of the thesis that we haven't covered?
I think for a global investor, it's what it's not.
Okay, what is it not?
So it's all the things we talked about at the beginning of being kind of the danger signs. So it's not a US growth stock with a big tech angle. And so it's very diversifying to an area of the market that I think is clearly hot. If you can own a series of those, I think you're probably better served over the next decade than you have been over the last.
What are some of the risks or red flags that you keep an eye out for companies like this?
It's really about conversation with management, how they're thinking about the business. And what we want to see is that they talk transparently and with integrity about the decisions that have been made in the business and what that's resulted in. So an honest appraisal of what's happening in the business. That's very Buffett-like quality. But then there would just be their commentary on what is happening in the world. And we appreciate that people make mistakes. Like, some things are unknowable. But to be able to hold your hands up and say, we're not sure, and so this is how we're thinking of structuring our investments in this area. Or this is how we're thinking about the auto market in Indonesia in the face of Chinese EV competition. And we want people to be demonstrating that long-term shareholder-friendly mindset. So not panicking when it's a cycle, but also being realistic about where business is being disrupted or where you have structural change, and then kind of calibrating their capital allocation decisions to that conversation. And so that the conversation we're having with them is reflected in the business over time.
Nice.
I just want to hold on risks, but I guess draw it out from Jardines and just with emerging markets more generally. I think part of the reason people have been turned off from emerging markets is the strength of the US dollar. And you mentioned earlier that it looks stretched relative to some of the other currencies in today. But I'm sure people, over the last few years have said the same thing, and the US dollar has just kept on keeping on. How do you think about risks more generally around the dollar when you're investing in emerging markets?
So we manage currency separately in our global portfolio. So we have a currency team who will take a view on this, and where we don't see the currency that we'd be exposed to through our stocks as good store of value, we'll shift. And so in recent periods, we've been underweight the US dollar and overweight the yen, is the way we've expressed it. I think broadly when we come to emerging markets, we try to avoid situations where we are particularly vulnerable to any given macro outcome. So if we had a business that was only profitable with a dollar to local currency rate of X, we would be very cautious, because we know that we can't, over any reasonable time frame, it's very difficult to predict where that lands. And if the business is going to be very weak in that environment, well, that might not be very attractive as part of your risk reward profile. It's kind of the same way we've approached tariffs. So we haven't talked about tariffs yet.
No. Yeah.
I think it's the longest I've gone. Tariffs are going to be noisy. and it's impossible to know where they will land. If you're making investments on the basis of any specific outcome, that to me feels very hard, because you could wake up tomorrow, open Twitter, and find your heart broken. So better to own businesses that are resilient in a range of outcomes that you think it captures most reasonable versions of the future, and then make sure that the valuation is attractive under most of those range of outcomes. And it would be the same for the way we think about something like FX, and you could say the same for like a commodity price or an interest rate. So we've had great experience in Europe with the banks, where after 10, 12 years of very low interest rates in Europe, people were very depressed about the outlook for these banks to be profitable. And we were able to invest at a point where we didn't need rates to go up to make a decent return out of the stocks, because they were priced incredibly cheaply. And so it wasn't a specific call that rates would go up, but we knew that if they did, we would earn some excellent returns, and we just had to wait. And that's played out, and it happened in Japan. It might happen in Korea. So I say what we try to do is embed upside optionality into our stocks, rather than make a specific forecast on a specific macro variable.
Love that.
Well, Simon, I'm sure there's plenty of other things that we can unpack, but we have reached the end today. Thank you so much. I've learnt a stack out of this conversation. Absolutely fascinating. I'm sure everyone listening did as well. So we appreciate your time.
Thank you very much.
Thanks, Simon. Well, that does it for this episode of Basis Points. Thanks for watching or listening. Remember to subscribe so you don't miss a future episode, and head to the description or the show notes to subscribe to the Basis Points monthly email, where we'll be sharing insights from Australia's largest community of everyday investors.
And a reminder that all of the content here at Basis Points is accredited by the FAAA and available for CPD points. All you need to do is click the link in the description, complete the quiz, and we'll send you your certificate.
Well, that'll do us for today. We'll see you next episode.